Year 2 activity between the parent and the sub. The information from Year 2, the sub has net income of 146 and dividends of 106, which we can see on the 3-part worksheet. And again, notice that the income from the subsidiary does not agree to the income sub. That is because the parent is only getting 80% of that. And you see again, I've broken that out for you. 146 times 80% is 116, 800. And 292, 200 goes to the NCI. We see there's dividends of 106. And then, again, just a quick reminder, this information is going to flow through the income sub account because we're doing the equity method of accounting during the year. Let's go ahead and record the subsidiary's net income of 146. So we're going to debit investment sub, credit income from subsidiary. 146 times 80% is 116, 800. We'll do the same for the dividends. 106 times 80% is 84, 800. We'll debit cash, credit investment subsidiary for 84, 8. We put all those together on one page. We get a nice recap. And from there, we can begin to compute our schedules. The first being our book value schedule. Remember that the book value schedule is an ongoing schedule. It's a balance sheet item. So the ending balance last year will be the beginning balance this year. And again, on the subsidiary side, the parent will get 80%, and the NCI will get 20% of the values for the subsidiary. We see the equity, which is in the beginning balance, the income, and the dividends. We're going to continue with our investment subsidiary reconciliation. And we see we've got the beginning balance, net income, dividends, for a balance of 640,952. That agrees to the book value schedule. You may have noticed that. We're going to continue to do the investment subsidiary reconciliation because when we add differential in Chapter 4, some of those differential items don't go on the book value schedule. They'll go on another schedule, and there's two separate schedules. So we're going to combine all that with the investment sub account and the NCI account. So here we go with the investment sub reconciliation. We'll do the same thing for the non-controlling interest. Now remember, this non-controlling interest is only going to show up during the consolidation process, so we're going to have to maintain an off-balance sheet schedule someplace that gives us the beginning and ending balance. And that's what we're going to do with this. So we've got a beginning balance of 152,238. 20% of the net income and 20% of the dividends for a balance of 160,238. We can now start the consolidation process. And you've got your consolidation worksheet for Year 2 in front of you, or here it is for your notes. If we start the EJEs, the first thing we're going to do is eliminate the current year activity between the parent and the sub, which is going to come from the book value schedule. We'll debit income from subsidiary, credit dividends, credit the investment. We'll continue in Year 2 with what we did in Year 1 with the NCI. And that information is going to come from the book value schedule as well. So with this entry here, we're assigning 20% of the income to the NCI and starting to come up with the increase in equity as well. So we had income to the NCI of 29.2, dividends 21.2, and the 8,000 represents the increase in equity for the NCI for this particular year. We'll do the subsidiary's book value, which will come from the book value schedule as well. So as you can see, a lot of information is going to come from here. So we need to be understanding what goes into here so you can have a nice, easy place to go to get your information when you're preparing the EJEs. We're going to debit common stock, debit retained earnings, credit the investment, and credit NCI. You see the recap here, and then we'll take a quick look at the EJEs posted to the three-part worksheet, taking a look at the particular items that we've discussed before. Investment sub is 0. Income sub is 0. Notice that $29,200 is the income to the NCI. And then the NCI has a value of $162.38 that's been assigned to it through 2 journal entries, EJE 2 and 3. We look at consolidated net income. We go through the same process as before. Separate operating income is $1,028,670 plus the subs net income. Then we allocate 20% of the subs net income to the NCI, and the difference is the income to controlling interest. Now notice, just a quick reminder here, that this income to NCI of $29,200, that represents 20% of the subsidiary's net income. It has nothing to do with the parent, so don't get confused and allocate 20% of the $1,174,670. That represents parent and sub. So that NCI number is just to the sub.